I want you to picture two people. They're the same age, working similar jobs that pay almost identical salaries, and they both walk into the same dealership on a Saturday morning to finance a $30,000 car. The first one drives away with a 4.2% interest rate on a 6-year loan. The second drives away with 12.8%. Over the life of that loan, the second person will pay roughly $8,500 more in interest on a car that came off the same lot, financed through the same dealership, signed on the same afternoon. Now here is what most viewers would assume happened. They'd assume the first woman earned her low rate the slow, honorable way. Years of paying every bill on time, sticking to a careful budget, never missing a due date. The classic story we get told about good credit. But that is not what happened. The first woman used a loophole. A real one, buried inside the American credit reporting system since 1974. It was built into a piece of federal legislation that was originally written to protect women's financial independence, and it has quietly become the fastest legal way to lift a credit score in this country. Banks know the loophole exists. Lenders see it inside the credit files they pull every single day. The average American, however, has never been told it's there. Not in school, not by their bank, not by their credit card company, and certainly not by the financial advice industry that gets paid to sell complicated solutions when simpler ones already exist. Today, we are walking through that loophole. We're also covering 7 other under-the-radar moves that the high-credit households in this country quietly use to climb the ladder in months instead of years. By the end of this video, you'll see the credit system the same way the mortgage industry sees it. You'll know which moves still work, which ones got nerfed by the new FICO 10T model that rolled out for mortgages this spring, and which ones the credit bureaus actively don't advertise because they undercut their own paid services. Let's start with why your score has felt stuck in the first place. Before we get to the main loophole, you need to understand a quiet truth about the credit system. The system is designed for slow movement by default. That is not a conspiracy theory. It is just how the bureaus actually function. Equifax, Experian, and TransUnion all operate on a monthly snapshot cycle. When your credit card company sends data to the bureaus, they send the balance that existed on a single day each month, called the statement closing date. Whatever was on the card that day becomes your reported balance for the next 30 days. Everything you did before that day disappears into history. Everything you do after only matters for the next snapshot. So when you pay down a big balance, your work doesn't show up immediately. It shows up on the next reporting cycle, which can be 20 days away. When you open a new account, the credit history for that account starts the day the bureau picks it up, not the day you applied. When you make perfect on-time payments for 6 months, the bureau is only counting 6 monthly snapshots. The system is not built to reward you in real time. It is built to reward you slowly enough that most consumers give up trying to optimize it. And here's the part almost nobody is told. The people sitting at the top of the credit ladder, the 760 plus crowd that gets the 4% auto loans and the best mortgage rates, do not all wait patiently for the system to come around. Many of them figured out the moves that compress years of normal credit building into weeks. They request soft pull credit limit increases on a calendar. They time their payments around the statement closing date instead of the due date. They use the authorized user mechanic to inherit decades of payment history overnight. And the gap between them and everyone else widens every year because they're buying houses at lower rates, financing cars at lower rates, and paying less for credit-based insurance products that quietly tax bad credit on a monthly basis. That gap, by the way, is enormous. A homeowner with excellent credit can save around $200 a month on a $400,000 mortgage compared to a borrower with average credit. Over 30 years, that is $72,000 in pure interest, money that could have been invested or used to build a real emergency fund instead. Auto loans, personal loans, refinancing offers, even apartment applications and certain employer background checks all tilt toward the people who optimize the system. So when we talk about the credit score loophole banks don't want you to use, we're really talking about the one with the steepest score impact in the shortest amount of time. the one that has been hiding in plain sight for 50 years. The loophole is called Authorized User Piggybacking. The name sounds boring on purpose. It sits inside the dry corner of credit law where most consumers stop reading. But here's what it actually does. When a credit card holder adds another person to their account as an authorized user, the credit card company reports that account to the bureaus under the authorized user's name. And here's the part the average American has never been told. The credit card company does not just report what happened after you got added. It reports the entire account history from the day the card was first opened. Read that one more time because it is the most important sentence in this video. The bank reports the full account history, not just the period since you were added to the account. If your mother opened a Chase Sapphire card in 2008, made every payment on time for 17 years, kept the balance under 10% of the limit, and added you as an authorized user yesterday, your credit report does not show 1 day of authorized user activity. It shows 17 years of perfect payment history attached to your name. The age of the account, the total credit limit, the running utilization, the unbroken on-time streak, all of that flows into your file. The credit scoring models read that account as if it were yours. The bureaus do not currently filter it out by default, and the impact on a thin credit file or a damaged file can be enormous. A Federal Reserve research paper published in 2010 studied this exact mechanism. Researchers added a single, high-quality, authorized user account to consumers across different score bands. The lowest credit score group, the consumers who needed the help most, saw their scores rise by an average of 22.4 points. Thin file consumers, the ones with 2 or fewer real accounts of their own, saw their average score climb from 44.6 to 64 in the modeling. That is a structural lift, not a marginal one. It's the kind of lift that moves someone out of subprime into prime territory in a single reporting cycle. A subprime borrower locked into a 15% auto loan today could realistically qualify for a 6% loan within 60 days of being added to the right account. And the Consumer Financial Protection Bureau published a working paper in 2025 confirming something even more surprising. Nearly a quarter of all American consumers with credit files first establish their credit history through some form of authorized user piggybacking. That is not a fringe technique sitting on the edges of the credit world. It's the front door for tens of millions of credit profiles. It's just that most of those consumers got piggybacked by a parent or a spouse without ever realizing what the bureaus actually did with that account, or how much of their adult credit standing was built on someone else's history. Now, you might be wondering why this is technically a loophole. Why doesn't FICO just filter out authorized user accounts? They tried. In 2008, FICO announced they would stop counting authorized user trade lines because trade line rental companies had started selling these spots to strangers online. Within weeks, FICO walked the change back. The Federal Trade Commission and the Federal Reserve raised concerns that removing authorized user trade lines would violate the Equal Credit Opportunity Act of 1974, the same law that originally created the protection. The act was passed to make sure women, who at the time often had no independent credit history of their own, could be added to their husbands' accounts and build a real file. FICO eventually rolled out updates in FICO 8 and FICO 10 that quietly weight authorized user accounts a little less, especially when the relationship looks suspicious. But the underlying mechanic is still in place. The history still transfers. And family members adding family members still works exactly the way it always has. So the practical move looks like this. If you have a parent, a spouse, a sibling, or even an adult child with a long-standing credit card account, low utilization, and a clean payment history, ask to be added as an authorized user. The primary cardholder calls the issuer or logs in online and adds your full legal name and social security number to the account. You typically don't even need to receive a physical card. You don't need to use it. You don't need to make payments on it. Within one full statement cycle, that account shows up on your credit report carrying all of its historical weight. The older the card and the lower the utilization, the bigger the lift will be. A few practical guardrails before you do this. The primary cardholder's behavior now affects your file too. So the worst case scenario is that they max out the card or miss a payment and you take the hit alongside them. Only piggyback on someone whose financial habits you trust completely. Avoid the commercial trade line rental industry. The companies that sell strangers' authorized user spots online for $200 to $1,000 per trade line. FICO 10 and many manual underwriting models are starting to filter those out when there is no shared address or family link in the data. And many lenders will discount the score boost during a manual review of a mortgage or auto loan file. But the family version of the move, the version that has been protected by federal law since the 1970s, that one still works. And it remains the single biggest score lift available to almost any consumer who has access to a willing family member with good credit. That brings us to the second move banks won't advertise, the statement closing date trick. This one alone has been documented to swing scores by 50 to 100 points within a single reporting cycle, and it costs you absolutely nothing. Here is the setup. Most credit card users believe their reported balance is whatever they happen to owe at the end of the month, or whatever they pay by their due date. That is wrong. Your credit card company sends a balance figure to the credit bureaus on one specific day each month. That day is called the statement closing date. Whatever the balance is on that day, that's what the bureau records. If you pay your statement off 3 days after the closing date, the bureau still sees the high balance that existed on the closing date. Your credit score still treats you like someone carrying that balance, even if you never paid a penny in interest because you cleared it before the due date. This creates a very specific opportunity. Find your statement closing date on the back of your most recent credit card statement or in the credit card app under billing cycle. Then pay your balance down to a small amount 3 to 5 days before that date arrives, not by the due date. The 3 to 5 day buffer accounts for payment processing time. When the closing date hits, the bureau records that small balance. Your utilization for that card drops. Your score moves up on the next reporting cycle, usually within 20 to 40 days. This is also where we need to talk about the real utilization target, because almost every consumer in America has been taught the wrong number. For years, the standard advice was to keep credit utilization below 30%. That number is roughly the line above which your score starts taking serious damage. But it is not the optimization target. People who actually sit at the top of the FICO score range, the 800 plus crowd, run utilization in the single digits. FICO's own published research has confirmed that scores above 760 are associated with utilization patterns that stay below 10% across all open revolving accounts. The high credit elite typically run between 1 and 9% on their reporting card, with everything else at 0. That has practical implications you can act on this month. If you have one card with a $5,000 limit and you regularly carry a $1,500 balance, you are sitting at 30% utilization. Your score is not being destroyed, but you are leaving 30 to 50 points on the table. If you can pay that card down to $250 before the closing date, your utilization drops to 5%. Within 60 days, your score reflects that change. No new income, no new accounts, no major changes to your financial life. Just better timing on a payment you were going to make anyway. The reason banks don't advertise this is straightforward. Credit card companies actually make money when you carry balances and pay interest. They are not incentivized to teach you the optimization that requires zero interest payments. The bureaus aren't incentivized to teach you the optimization either, because their entire premium credit monitoring business model relies on consumers feeling confused about their score. The information has been available for decades inside disclosure documents and FICO research papers. It just isn't part of mainstream financial education in the United States. Now we need to talk about the third move, which sits right next to the utilization trick and amplifies it dramatically. It is the soft pull credit limit increase. And this one, more than almost anything else on this list, separates people who climb the credit ladder fast from people who climb it slowly. The math behind this move is simple once you see it. Your utilization is a ratio with two moving parts. The numerator is the balance you owe, and the denominator is the credit limit you have available across all your cards. If you only ever work on lowering the numerator by paying down balances, you are doing half the work and ignoring the other half. You can also raise the denominator. If your balance stays the same but your credit limit doubles, your utilization gets cut in half overnight, and the score boost lands within the next reporting cycle. That kind of impact, achieved without changing your spending habits or paying down a single dollar of debt, is exactly the type of optimization the high credit households have been quietly running for years. The catch most consumers run into is that some banks treat a credit limit increase request as a hard inquiry. A hard pull dings your score by a handful of points and sticks around for 2 years, which feels counterproductive when the whole goal is to raise your score. So most people don't ask. But here's what most people don't know. Several major issuers offer soft pull credit limit increases that have zero score impact, and they have specific rules around when and how to ask. American Express is the gold standard for this. Amex does not run hard pulls on customer-initiated credit limit increase requests. They run a soft pull every single time. You can submit your first request as early as 61 days after opening the card. After that, you can request a new increase every 90 days if denied, or every 180 days if approved. Amex will approve increases up to roughly 3 times your current limit in a single request, and the cap compounds. Get approved for a tripling now, wait 6 months, request another tripling, and the credit line can grow into the tens of thousands of dollars over a few years without ever hurting your score. Capital One offers soft pull increases through its online portal once every 6 months. No phone call required. Discover handles increase requests online or by phone, and a representative will usually warn you in advance if a hard pull is going to be required. Citi tells you upfront in the app whether a request will trigger a soft or hard pull. Wells Fargo and U.S. Bank typically allow soft pull increases on personal cards through their existing customer review process. The major issuers that still run hard pulls for cardholder-initiated requests are Chase, Bank of America, USAA, and Barclays. So if you have cards across multiple banks, focus your increase requests on the soft pull issuers. Stack them on a calendar. Request from Amex every 6 months, from Capital One every 6 months, from Discover every 3 months. Within a single calendar year, a disciplined user can roughly double their total revolving credit limit, and their utilization ratio drops by half without paying down a single dollar of balance. And here is the most underused angle to all of this. When you request the increase, the bank usually asks for your current annual income. If your income has gone up since you opened the account, even a little, update it before you submit the request. The internal underwriting model considers income relative to current limit when deciding whether to approve an increase. People who never update their income on file are quietly capping their own approval potential, sometimes for years. Hey, if you're getting value out of this so far, take a second to subscribe before we keep going. The next half of this video gets into the biggest moves on the list, including the lender-only 48-hour score update that almost nobody knows about, and the credit scoring model change rolling out across the mortgage industry right now that is going to reshape which moves still work in 2026. Hitting subscribe lets the channel keep producing this kind of breakdown every week, and it helps the algorithm push these videos to more people who actually need them. All right, let's get into the fourth move. It is called the AZEO method, which stands for All Zero Except One. It is the strategy used by people chasing 800-plus credit scores. And once you understand why it works, you start to see exactly how the scoring model thinks about utilization. Here is the principle. FICO and VantageScore don't just look at your overall utilization across all of your cards combined. They also look at per-card utilization on each individual account. So if you have 5 credit cards and 4 of them are at 0% utilization, but 1 is at 60%, the model still flags the high utilization on that single card. Your overall ratio might still be in single digits, but the existence of one card running hot pulls your score down anyway. The other surprising piece of this is that having every card report a balance of 0 actually hurts you slightly. The scoring models seem to want to see at least one active card with a reported balance to confirm you are still using credit. When all of your cards report 0 across the board, the model interprets that as no recent credit activity, which is a small but real negative. So the AZEO method engineers your reporting in a very specific way. You pay every single card down to a 0 balance before its statement closing date, except for one card. That one card, ideally a major bank card like a Chase Sapphire or an Amex, you let report a small balance between 1 and 9% of its limit. That single reported balance signals active credit use. The 0 balances on the rest signal disciplined utilization. The combination is what unlocks the 800+ tier. People who hit AZEO consistently for 3 to 6 months often see their scores jump by 20 to 40 points relative to where they were before, which can be the final push needed to qualify for the lowest mortgage rate available in any given quarter. The fifth move is one of the most underused tools in the entire credit world, and it is only available through a mortgage lender. It is called rapid rescoring, and it is the closest thing to a real magic button that exists in this system. Here is the situation it solves. You apply for a mortgage, the lender pulls your credit and tells you that your score is 15 points below the threshold for the rate you wanted, or 20 points below the threshold for any approval at all. You know exactly what you need to do to raise your score. Maybe pay down 2 credit cards, get an old reporting error removed, or push a paid collection to update its status. The problem is that the bureaus take 30 to 60 days to update credit reports after a change, and another 30 days to reflect that change in your score. The mortgage process is on a much tighter timeline and won't wait that long. Rapid rescoring solves the speed problem. Through partnerships with the 3 major credit bureaus, mortgage lenders can submit documented proof of a credit change directly to Equifax, Experian, and TransUnion, and get your credit file updated within 2 to 7 business days, sometimes within 48 hours. The lender pulls your score again after the update lands. The new number reflects all the changes immediately, and suddenly you qualify for the rate you wanted, or you qualify at all. The reason this is one of the best-kept secrets in personal finance is that you cannot request rapid rescoring yourself. The service is only available through lenders, primarily mortgage lenders, because the bureaus charge them around $30 per credit file rescored. So you have to know to ask for it directly. Most loan officers will not bring it up unless prompted by the borrower. The buyers who walk into closing with a better rate are usually the ones who specifically requested a rapid rescore after their initial application, then provided the documentation needed to make the rescore happen. Use it for 2 situations specifically. The first is when you have legitimate documented credit improvements that just need to be reflected in the score, like a paid down balance or a corrected error. The second is when a credit report error has been blocking an approval. In both cases, the lender submits documentation to the bureaus update the file in days instead of weeks, and the score moves before underwriting locks in your rate. A 15 to 40 point score boost in under a week can be the difference between a 4.5% mortgage and a 5.7% mortgage, which on a $400,000 loan adds up to $50,000 to $70,000 over 30 years. What rapid rescoring will not do is fix accurate negative information. It cannot remove a real late payment or a real collection account. It only accelerates the updating of legitimate changes that were going to happen anyway. The reason it works so well is the speed gap, not any rule bending. The 6th move is the one that has changed the most in the last 2 years. It is the Experian Boost mechanic combined with the new rent reporting infrastructure. And the way it interacts with credit scores in 2026 is dramatically different from how it worked a few years ago. Experian Boost is a free service that lets you connect your bank account, identify recurring on-time payments for utilities, phone bills, certain streaming services, and most importantly, rent, and have those payments added to your Experian credit report. The average user who connects Boost sees an increase of around 13 points to their FICO 8 score on Experian. People with thinner credit files often see bigger jumps, sometimes 20 to 30 points. The data only affects the Experian-based versions of the scoring models, not Equifax or TransUnion. But for many lenders, that distinction still matters because of which bureau they pull from during underwriting. Rent reporting has become a much bigger deal recently because of the new VantageScore 4.0 model and FICO 10T. Both models weight rent and utility payment history more heavily than older versions, and Experian announced in early 2026 that its Connect API platform now supports VantageScore 4.0 for rental screening. According to a TransUnion survey, the share of consumers whose rent payments get reported to the credit bureaus rose to 13% in 2024, up from 11% the year before. And that number is climbing every quarter as more landlords and platforms adopt the practice. The practical move here is to use a rent reporting service if your landlord doesn't already report rent for you. Services like Rent Track, Built Rewards, and Rental Karma can push your monthly rent payments to one or all three bureaus. Some of them will report up to 24 months of past payments retroactively for an additional fee, which can add years of payment history to a thin file overnight. The Built MasterCard is unique in this category because it lets you pay rent with the card without paying the typical processing fee, and the on-time payment history reports directly to the bureaus. For renters who have been making payments for years without any of it counting toward their credit, this is one of the easiest score lifts available right now. The seventh move is the most overlooked legal protection in the entire credit reporting system, and it is built directly into the Fair Credit Reporting Act. It is the dispute and goodwill letter process, and most consumers either never use it at all or use it in the wrong order. There are three distinct tools here, and using the right one for the situation matters a lot. The first is the credit dispute letter, which is what you send when information on your credit report is actually wrong. Maybe a late payment that didn't happen, a collection account that isn't yours, or a balance that's incorrectly higher than what you actually owe. The FCRA gives every consumer the right to dispute inaccurate information directly with the credit bureaus, and the bureaus have 30 days to investigate and either verify the information or remove it. If the original furnisher of the data cannot verify the entry within the 30-day window, the bureau is legally required to delete it. Studies have found that around 40% of credit reports contain at least one error worth disputing, and most consumers have never pulled their reports closely enough to notice them. The second tool is the goodwill letter, which you send when the negative information is technically accurate, but you have a strong reason to ask for forgiveness. Maybe you had one late payment 3 years ago because of a medical emergency, and your account has been spotless since then. A goodwill letter goes directly to the original creditor, not to the bureau. You write a polite, brief request, usually under 300 words, that owns the mistake, references your strong overall payment history with the lender, explains the circumstance, and asks the lender to remove the late mark as a one-time courtesy. Big national banks usually decline goodwill requests as a policy matter, but smaller credit unions and regional lenders honor them more often than people expect. There is no legal requirement for any creditor to grant a goodwill deletion, but the success rate is high enough that it is always worth trying when the situation fits. The structure of an effective goodwill letter is straightforward. Open with a single sentence acknowledging that the late payment was your fault. Reference how long you've been a customer and how clean your record has been outside of that one incident. Briefly explain the circumstance, ideally 1 or 2 sentences, without making excuses. Close with a specific request to remove the late mark and a clear thank you. Send it by certified mail with return receipt requested, addressed to the creditor's credit reporting or executive relations department. Keep copies of everything. If the first request gets declined, wait 60 days, build up another stretch of perfect payments, and try again with a slightly different angle. Persistence matters here. Many successful goodwill removals took 2 or 3 attempts before the lender agreed. The third tool is the Pay for Delete letter, which you can send to a collection agency to offer payment of a debt in exchange for the agency removing the collection from your credit report. This one is more controversial. The credit bureaus officially discourage the practice. Newer scoring models like FICO 9, FICO 10, and VantageScore 4 already weight paid collections much less heavily than unpaid ones, and VantageScore 4.0 ignores medical collection accounts entirely. So the value of pay for delete has dropped over time. But for accounts that fall under older scoring models, still used in some mortgage decisions and auto loan approvals, it can still meaningfully move a score. A quick note on medical debt specifically, because the rules here changed multiple times between 2022 and 2026. The 3 major credit bureaus voluntarily removed paid medical collections from credit reports starting in 2022. They also stopped reporting any medical collection accounts with an initial balance under $500. The Consumer Financial Protection Bureau finalized a rule in early 2025 that would have banned all medical debt from credit reports, but a federal court vacated that rule in July of 2025, and the ruling is no longer enforceable as of 2026. So the protections still in place are the voluntary bureau actions, not a federal mandate. Medical debt over $500 can still appear on your credit report. The waiting period before unpaid medical debt can be reported was extended from 6 months to 1 year, which gives consumers a full 12 months to resolve a bill before it hits their score at all. There is one more move worth covering before we get to the 2026 scoring overhaul, and it is the rate shopping protection that almost nobody uses correctly. When you apply for a mortgage, an auto loan, or a student loan, each application triggers a hard inquiry that normally hits your credit score by a few points. If you're rate shopping across 5 lenders to find the best deal, you might assume that means 5 separate hard inquiries and a meaningful score drop. The FICO scoring models actually include a deliberate protection against this. All mortgage, auto, and student loan inquiries that fall within a 14 to 45-day window get grouped together and counted as a single inquiry for scoring purposes. The exact window depends on which version of the FICO model is being used, but the protection itself is consistent across recent versions. So the practical advice is to compress your rate shopping into a tight window. Apply to all the lenders you want to compare within 2 weeks of each other, get all the quotes you need, and your credit score takes the hit of a single inquiry instead of 5. Spreading the same applications out over 2 or 3 months would multiply the damage unnecessarily. Now we need to talk about the change that is reshaping all of these moves right now, the 2026 credit scoring model shift. Because some of the tactics that worked 5 years ago are getting weaker, and a few new ones are becoming significantly sharper. In April of 2026, the Federal Housing Finance Agency officially approved VantageScore 4.0 for use in mortgage underwriting by Fannie Mae and Freddie Mac. FICO 10T, the trended data version of FICO 10, is being phased in as a permitted scoring model alongside it. For the first time in decades, the classic FICO scoring model is no longer the only score that determines whether someone qualifies for a conforming mortgage. The Federal Housing Administration is also moving toward using these newer models for FHA loans, which are the loans many first-time buyers depend on. The difference matters. FICO 10T uses what's called trended data, meaning the model looks at a rolling 24-month window of your credit behavior instead of just a snapshot of where you sit today. Someone who has been steadily paying down credit card balances for the past 2 years gets credit for that downward trend, even if their current balance happens to be the same as it was last year. Someone whose balances have been creeping up gets penalized for that upward trend, even if they're still under the 30% utilization line. The single-month statement date trick still works, but the underlying trend now matters more than ever. Consistent low utilization over 24 months matters more than occasional 1-month optimization right before a credit pull. VantageScore 4.0 takes a different approach. It weights payment history slightly more heavily, weights credit utilization slightly less heavily, and explicitly incorporates rent and utility payment history when that data is available in the bureau file. For renters who have always paid on time but never had that payment history captured, VantageScore 4 can boost their score in ways the classic FICO models simply could not. People with thin credit files who have years of clean rent payments are about to get rewarded by the mortgage industry for the first time, which is one of the most consumer-friendly changes the scoring world has seen in a generation. What this means in practice for the moves we just walked through is fairly simple. Authorized user piggybacking still works in both new models, though VantageScore 4 originally launched with logic to exclude authorized user trade lines and has since softened that position. The statement closing date trick is becoming a little less impactful in isolation under FICO 10T because trended data smooths out one-time optimizations, but it still works as part of a long-term low utilization pattern. Soft pull credit limit increases still work everywhere because raising your denominator helps under any model. Rapid rescoring still works for mortgage applications. Experian Boost and rent reporting are dramatically more effective under VantageScore 4. Dispute and goodwill strategies still work because they target the underlying credit report data, not the scoring algorithm. The biggest takeaway is that the consumers who win in 2026 are going to be the ones building consistent 24-month patterns instead of last-minute fixes. The window for short-term gaming of the system is narrowing. The window for disciplined, long-term optimization is widening. Anyone who learns to use these moves now, while there's still a transition period between the old models and the new ones, is going to be sitting in a much better position than the consumers who only adapt after the changes are fully baked in. Which brings me to the part of this video that matters more than any of the tactics. And I want to be honest with you about it. Knowing the moves is not the same as understanding the game. Every loophole I just walked through has the same underlying weakness. It only works for people who already understand the fundamentals of how money flows through the credit system, how lenders make decisions, how interest compounds against you when you carry a balance, and how a high credit score connects to every other piece of your financial life. Without that foundation in place, the tactics turn into shortcuts that cause as much harm as they prevent. I have watched people use the authorized user trick to qualify for a mortgage they couldn't actually afford. I have watched people use soft pull credit limit increases to convince themselves they could spend more, then end up with five-figure credit card debt at 24% interest. I have watched people optimize their statement closing date to chase an 800 FICO score while quietly skipping retirement contributions for years. The tactics work, but only as multipliers on top of an underlying financial foundation. Without that foundation, they become very efficient ways to dig deeper holes. This is why, if you're new to thinking seriously about your money, the place to start is not actually credit, it is financial literacy. The real understanding of how the entire system works, including how debt compounds, how interest moves through your different accounts, and why some forms of debt build wealth while other forms quietly destroy it. The understanding of how to think about your credit score, not as a number to maximize, but as one piece of a much bigger picture that includes savings rates, investment compounding, and the relationship between cash flow and net worth. Once that foundation is in place, the tactics in this video stop being shortcuts and start being optimizations. They start working with you instead of accidentally against you. If you've never sat down and really worked through the basics of personal finance from the ground up, this is the right starting point. And I made a full video on the channel that walks through it in plain English. It covers the 8 or 9 ideas that the entire field of personal finance rests on, the mistakes that quietly cost the average American hundreds of thousands of dollars over a lifetime, and the order you should actually tackle financial goals in instead of the random order most people end up tackling them in. Watch that one next. It will make every move you just learned in this video work twice as hard for you, because you'll understand exactly why each one matters and where it fits into the bigger plan you're building. Your credit score is one of the highest leverage financial tools you'll ever have access to in your life. The loopholes are real. The tactics work, but the score itself is only worth what you do with the financial life it unlocks. Take care of the foundation first, layer the tactics on top of it, and the gap between you and the average American consumer will widen every year in your favor. I'll see you in the next one.